Welcome to the Deep Dive, your way to get really well-informed quickly.
Yeah, we cut through the noise for you.
Exactly. Today, we're looking at the second quarter 2025 earnings call from, well, a big name in the utility space. It's our kind of TalkTickers approach. We pull out the important stuff, cut the jargon, and help you figure out what actually matters from their latest numbers and plans.
That's the goal. It's not just reading out figures, right? It's about seeing the connections, what's driving things, and what it all means for the company and maybe the whole sector.
Definitely. We'll get into the performance, how they're executing on strategy, and those bigger trends impacting them.
Sounds good.
So let's maybe kick things off with just a quick look at the results, because, I mean, the headlines look pretty strong.
They did, yeah. Pretty solid quarter financially. They beat what the analysts were expecting on the key stuff.
Okay, so what specifically stood out in those numbers?
Well, the GAAP EPS is the standard accounting earnings per share. It came in at grotto 88 cents, which was, quite a bit higher than the consensus estimate, around 76 cents.
Right.
But the one investors often focus on even more is the operating EPS. That's the non-GAAP number, kind of strips out the unusual items.
Just a clearer picture of the core business.
Exactly. And that also outperformed, came in at 75 cents versus estimates around even 69 cents.
And revenue looks strong too, didn't it?
Yeah.
Over $3.8 billion.
Yeah, $3.81 billion. Beat the estimate of $3.64 billion pretty comfortably. That's like 9.3% growth compared to last year.
Wow. Okay, so a solid beat across the board. The market liked it, you said.
Oh, yeah. Immediate positive reaction. Investors seem pretty happy.
What does a clean beat like this really signal? Does it say something about their execution?
I think it does. It suggests management's building that track record,
Yeah.
hitting or beating expectations.
Consistency is key in utilities.
Totally. Especially in a regulated business. When they deliver consistently on both GAAP and operating numbers, plus show good top-line growth, it just signals they're really managing things well.
Okay, so let's dig a bit deeper then. Let's unpack the financials, the drivers behind that beat.
Sure.
That operating EPS beat, it wasn't just one thing, was it? There were several factors pushing it up.
Right. There were a few tailwinds. For example, they got $0.02 from something called RNG 45Z credits.
Okay, R&D 45Z credits, quick explanation for folks maybe not familiar.
Yeah, sure. They're federal tax credits for producing renewable natural gas, think capturing methane from landfills, farms, that kind of thing.
Okay.
So it's basically a financial boost for investing in cleaner tech, aligns with decarbonization, and hits the bottom line directly.
Got it. So that helped. What else?
Well, there was a cent from weather being better than normal utilities. Always get a bit of that sometimes. And then a pretty significant chunk, $0.07, came from regulated investment growth.
7 cents from regulated investment growth. That sounds like a lot. What's that telling us about their strategy?
It tells you they're putting serious capital to work in their regulated business. Things like grid upgrades, new power plants where they get a set return approved by regulators.
Predictable earnings stream.
Exactly. That's what investors love about utilities, especially when markets are choppy. Plus, they had higher sales that added another 7 cents, and a $0 SAF boost from a rate case settlement DEEAC back in 2024.
Right, the DESC rate case. Remind us what that's about.
Yeah, DESC stands for Distribution, Earnings, and Efficiency of Service. It's basically a regulatory process where they go to the state regulators to adjust rates, recover costs, earn a fair return on what they've invested.
So a good settlement there means better revenue.
You got it. A favorable outcome like this one means they secured a good framework for collecting revenue, which helps earnings directly.
Okay, so lots of positives. But there was an offset, right?
Yeah.
Something about a refueling outage.
Yeah, there was a $1.07 headwind from a planned refueling outage at their Millstone Unit 3 nuclear plant. That's pretty standard, happens regularly.
But even with that, they reaffirmed their guidance for the full year.
They did. Kept the 2025 operating EPS range at $3.28 to $3.52. The midpoint's $3.40, and that includes the benefit from those RNG credits we mentioned.
What does reaffirming guidance, especially after a beat, tell you? Are they being conservative or just confident?
It suggests they think the drivers are sustainable, or at least they have other things working in their favor later in the year. They didn't just automatically raise the guidance because of the beat.
Okay.
It feels like a disciplined approach, sticking to their long-term plan. And they reiterated that too, the 5 to 7% long-term EPS growth rate, the CAGR, off this 2025 base.
And the dividend. Always important for utility investors.
Unchanged, still on track for $2.67 per share. Another signal of confidence and stability.
Gotcha. And on financing, they mentioned completing their 2025 ATM program and de-risking 2026.
Right.
What's an ATM program and why is de-risking it good?
So ATM means at the market. It lets them sell new shares directly into the market over time, kind of dribble them out instead of one big sale. It's flexible. De-risking the 2026 program means they've likely already lined up a good chunk of the funding they'll need next year, maybe through early sales or other agreements.
Locking things in early.
Yeah, it shows they're being conservative with the balance sheet, want to keep their credit ratings solid, and just reduce uncertainty around funding those big capital plans they have.
Makes sense. That proactive approach is definitely a positive sign. Okay, let's shift to strategic execution. They talk about three main priorities, right?
Hit the financial targets, keep the big coastal Virginia offshore wind project CVOW on track, and get good outcomes from regulators.
Are they just saying that or are they actually doing it? Let's start with CVOW. That thing is huge.
It really is. And it seems like they are delivering. They said it's now 60% complete. First power still looks like early 2026. Full completion by the end of 2026.
And that's almost 3 gigawatts of power?
Yeah, close to 3 gigawatts for Virginia's grid. Enough for what, like 660,000 homes potentially?
The construction update sounded impressive too. 76% of monopiles done.
Yeah.
100% of pen piles. A record month for installations.
Right. 26 monopiles installed just in July. That's almost one a day.
Yeah, that's moving.
Over 90% of the monopiles are delivered now too. It really points to strong project management. Offshore wind can be super complex, prone to delays.
So this pace is a good sign.
Absolutely. Hitting these milestones, especially on the foundations, builds a lot of confidence they can meet the overall timeline. I also talked about the Corvus vessel.
Yeah, yes, the special installation ship.
Exactly. Sounds like it's finishing commissioning next week, then starting sea trials right after.
There was a small delay getting it there. Something about cables.
Yeah, electrical cable terminations. But management stressed how vital it is for installing the turbines safely and efficiently. The cost is holding steady at $715 million, too.
Okay, but the overall project budget did go up slightly.
Yeah, by $70 million this quarter, bringing the total to $10.9 billion. They said it was due to incurred tariff costs.
Tariff costs, like import duties on parts.
That's likely it, yeah, components coming from overseas. But they framed it as pretty minor in the grand scheme. Said it would only add maybe 3 cents a month to the average residential bill over the whole life of the project.
That doesn't sound too bad. And the cost of the energy itself? The LCOE?
Still looking very competitive. $63 per megawatt hour. And that includes the value of the renewable energy certificates, the RECs.
And why is that $63 number significant?
Because it stacks up really well against other options for new power generation. LCOE is basically the all-in cost to build and run the plant per unit of energy.
So cheap, clean power.
Relatively speaking, yeah. For offshore wind at this scale, hitting that number, even with RECs factored in, makes it a really attractive long-term energy source for the state. Suggests good planning, maybe good supply deals.
They also mentioned something about PJM transmission costs, expected in September.
Right. PJM is the grid operator for that whole region. They coordinate the big power lines. The costs for upgrading the transmission network to handle all this new wind power are expected soon. But importantly, management said they don't expect any huge surprises like the industry saw back in February.
So more cost certainty there, too. Another de-risking element.
Exactly. Big, unexpected transmission costs could mess up the project's economics. So hearing they don't foresee major issues is definitely good news.
Yeah. Okay, so the CVOW seems to be progressing well. What about the regulatory side? Any big wins there?
Yeah, a couple of notable ones. In South Carolina, they got the Energy Security Act passed.
What did that do, practically?
It basically makes it easier and more predictable for them to recover the costs of investments they make, especially for things like joint gas resource development, better cost recovery mechanics.
So less risk when they invest.
Pretty much. It provides more certainty around earning a return on those long-term investments.
And the nuclear plant license extension, VC summer.
Huge win. The NRC granted a 20-year extension. That plant now runs through 2062.
Wow, 2062. That's securing a lot of zero-carbon power for a long time.
Invaluable, really. Nuclear is reliable, runs 24/7, no carbon emissions, extending the license locks in a massive chunk of their clean energy supply way into the future. Big de-risking move for their climate goals.
And back in Virginia, the biennial review seems on track. discussions about a slightly higher ROE.
Yeah, the review is moving along, expecting an order in November. They mentioned talks around a potential 9.8% allowed return on equity.
Which is up slightly from where they are now.
Just slightly, yeah, 10 basis points higher. But even a small bump in ROE can mean significant money for a utility this size.
Because it's the profit they're allowed to earn on their investments.
Exactly. So a higher allowed ROE boosts profitability, helps fund growth. They also sounded like a potentially contentious issue around capacity expense isn't likely to be a major fight, which is good for getting it resolved smoothly.
And that Chesterfield gas plant project is moving forward, too.
Yep, the Chesterfield Energy Reliability Center. It's a 1 gigawatt natural gas facility. Looks like it got supportive testimony from the Attorney General's office, hearing set for September.
So overall, sounds like good progress on the regulatory front, getting the framework they need.
Definitely. These wins are critical for enabling that big capital plan they have.
Okay, let's switch to the macro picture. They highlighted strong sales growth, right? Driven by data centers.
Very strong. And yeah, data centers are a huge part of it, plus just general economic growth in their areas. Get this. 9 of their top 10 peak demand days ever in Virginia happened this year.
9 out of 10 this year. That's incredible.
Isn't it? They said data center interest is as robust as they have ever seen it.
Wow.
And they're calling this AI-driven data center load a structural tailwind, not just a temporary thing.
Structural tailwind.
Yeah.
What does that imply for a utility?
It's a game changer, potentially. Utility load growth is usually kind of slow, tied to population growth, maybe some industrial expansion.
Right.
But AI, the computing power needed for training these models, running the applications, it's immense. It creates these concentrated pockets of massive new electricity demand.
So it's like a whole new high-growth industry popping up in their backyard.
That's a good way to put it. It forces them to rethink grid planning, investment, everything for years to come. It's a fundamental shift.
That's a really powerful dynamic. They also mentioned being happy with recent tax reforms, OB3.
Yeah, particularly around tax credit eligibility. Sounds like they feel confident they'll get basically all the credits they were forecasting. Just a tiny bit needs active management.
And these are credits for clean energy projects, mostly.
Largely, yeah. Things related to the IRA, like the 45X, 48C credits from Treasury, getting clarity and confidence on those is vital for the economics of projects like CVOW.
And they emphasized passing benefits to customers.
Right. Because their projects are regulated, mandated by state law, they focus on affordability. Passing through tax benefits helps keep customer bills down, which also helps keep regulators happy. It aligns everyone's interests.
Okay, let's pull this all together in terms of investor context. The stock popped after the earnings. Volume was high. Lots of call option activity.
Yeah, stock went from about $58.45 to close over $60, like a 3.35% jump on the day. High volume, bullish options activity all signals the market liked what it heard.
And how's it done recently compared to other utilities?
Pretty much in line. Total return over the last 3 months was about 10.2%, close to the sector average. They had some good news leading into the call, too, like a CVOW update, the nuclear extension, the dividend declaration. That probably helps set the stage.
You mentioned the broader sector. Higher interest rates have been a drag, but AI and the IRA are helping sentiment.
Yeah, higher bond yields make utility dividends relatively less attractive, so it puts a lid on how much investors will pay for the stocks in a multiple. But yeah, the whole AI load growth story and the incentives from the Inflation Reduction Act have definitely improved the mood around utilities. And this company, focusing on zero carbon regulated assets, looks pretty well positioned defensively compared to some peers.
Why is being defensive good right now?
Well, defensive stocks tend to hold up better if the economy slows down because people still need electricity. So they offer that stability. But by shifting to regulated clean energy, they're also less exposed to volatile fuel prices. And then you add this AI growth kicker. It's a compelling mix of defense and growth potential.
So stability plus a growth story.
Kind of the best of both worlds, potentially. Management sounded really bullish, kept hitting themes of execution and de-risking. Investors, the buy side, they seem to welcome the clean beat, the reaffirmed guidance. And CVOW progress was often mentioned as the biggest swing factor.
Were there any concerns raised?
Some analysts noted the heavy capital spending might squeeze free cash flow near term, which isn't surprising with projects like CVOW. But overall, the reaction seemed overwhelmingly positive.
And it feels like they're rebuilding credibility after maybe some issues last year.
Definitely seems like it. This is the fourth straight quarter they've beaten operating EPS consensus. That huge $50 billion 5-year investment plan is still on track, and they've locked in the financing at good rates. That kind of steady execution is exactly what investors want to see.
So what are the key things to watch for next?
Well, in Q4, we should get an updated capital spending plan, the final word on that Chesterfield gas plant approval, the ruling from the Virginia Biennial Review, and probably the next big CVOW construction update. Those will be important checkpoints.
Bigger picture things.
Still watching for final guidance from Treasury on those 45X48C tax credits, and of course what the Federal Reserve does with interest rates. That always matters for utility valuations.
So the story arc is moving from cleanup to growth.
That's the narrative, yeah. Leverage the regulated business, ride the AI wave, deliver that 5-7% earnings growth, and hit that goal of over half their generation being zero carbon by 2035.
Okay, now for our favorite segment. This is not financial advice.
Let's get outrageous, but plausible.
All right. Given everything we've talked about, the execution, CVOW getting de-risked, that AI tailwind looking real, here's an idea.
Lay it on us.
What about going long this company, maybe using long-dated, slightly out-of-the-money call options? Gives you leverage to the upside.
Okay, interesting. And how would you maybe fund that, theoretically?
Well, you could consider pairing it with a short position in a broad utility sector ETF. Specifically, one that holds utilities without that clear AI data center demand driver.
So a pairs trade, essentially, betting on this company to outperform the general utility pack.
Exactly. The thesis is that their unique load growth from AI allows them to break away from the herd, maybe get a higher valuation, a multiple re-rating, even if the broader sector faces headwinds from interest rates or just slower growth. They ride the AI wave while others don't.
It's definitely playing that specific AI angle hard. Makes sense as a concept, but again...
Absolutely not financial advice.
Yeah.
Purely illustrative, food for thought.
Right.
So wrapping up, this quarter really showed a company focused on execution. Clean beat, solid progress on the massive offshore wind project, good regulatory wins.
And that AI data center demand emerging as a really powerful, potentially game-changing structural tailwind for them.
Could reshape their growth path for years.
Absolutely. So remember, everyone, the trade idea was just for discussion.
Please don't run out and do it based on us talking about it.
But the big question it raises is interesting. Is this AI demand surge fundamentally changing how we should value certain utility companies? What do you think? Something to chew on.